coming towards the end of September, you still have 1 quarter left to go for tax planning. This is the time that you should be sitting down with your tax guy and letting him know the moves that you've made this year and he will help you figure out what your tax exposure is going to be. And you've still got 3 months to make changes if need be to try and minimize those taxes. Okay. So let's talk a little bit about tax drag. I think this is so important because people don't get the fact that taxes saved is another stream of income. If I told you that because of bonus depreciation and different moves that we make, that we saved $100,000 in taxes last year, I would be minimizing that amount, number one. But number two is, I just want you to know how important it is that everybody takes the time, regardless of what level they're at, to get in the habit of talking to their tax. So structure over deduction, okay? Oftentimes we sit down, I call it the H&R block factor, right? It was where we're looking for deductions when really it's all about structure. So structure talks about pay yourself tax efficiently. Number one, what does that mean? You'll often hear that, and I'm not going to go too deep in the weeds on this, but I will share with you, I was being advised, I've shared this before, by my tax advisors, that somebody that does what I do for the company you'd be paying them $150,000 a year, so that's what I should do for a paycheck. When in reality, for what I was doing, I had a range. That range was 70 to 150. They were actually really putting me on the conservative side, having me pay $150,000 in W-2 income, when it really should have been closer to $80,000. So really analyze that, analyze what you're doing, do some additional legwork, and make a decision on your own. Remember, who's the quarterback for your taxes? You are. You've got a team, hopefully you've got a team that advises you. Same thing with your wealth, same thing with your business, all of those things, same thing with your real estate. You've got many advisors, but at the end of the day, you are the quarterback and you make those decisions. Tax rate arbitrage. A lot of businesses, I will tell you, one of the things that we did is we formed a C Corp, and that C Corp was our management company. For those of us that own businesses, for those of you that own multiple businesses, that C Corp being a management entity meant that that C Corp did a lot of things for my business. Okay, marketing, they did the hiring, they did the onboarding. So that management company got a fee from all of my auto repair shops as well as my real estate businesses, and because that was a cost to do business, it lowered my tax exposure for my auto repair shops and used it up within a C Corp, which is taxed much more efficiently. Okay, C Corp is about a 20% tax rate. Those businesses is about a 35% tax rate. So I know this is deep in the weeds, but knowing the different taxable incomes and different entities, remember, entities have two reasons. One of them we all know about because they tout it so often. That is asset protection. Correct? Everybody with me? Yes? The other reason is taxes. And knowing which entity makes the most sense for taxes within your state is a very, very, very important tax savings tool. And you want to plan your exit before you go in. What is your exit on this investment? For real estate, that's easy. It's sometimes on apartments, it's a 3 to 5 year plan. So knowing what your exit is on anything that you're going to put in is going to help your tax advisor give you the right advice, right? So you want to invest tax efficiently, like savvy tax planning, and we talked about this. We'll beat a dead horse. I think this is so important. Savvy tax planning is the lowest risk way to immediately boost your investment returns, right? So knowing what your exit strategy is, knowing what your plan, knowing what bucket that you're investing out of. We're going to talk a little bit about that too. So in general, your long-term capital growth investments go in your taxable accounts, right? Because they're not going to be taxed as ordinary income, which is the highest tax rate. Ordinary income cash flow investments go in your tax advantage account. I'm going to give you an example, and it's a good one. I hard money loan. I loan to house flippers. Just so you know, if you don't know, that's 50% tax money. That is taxed at ordinary income levels. Okay, it's short term. That's 3 to 6 months. So if I use cash, I give 50% back to the government. right? I don't mind paying the government what they're due, but I don't want to waste money either. But if I use my Roth for that same exact loan, the taxes are zero. I don't owe any taxes, and I continue to compound my retirement account. So, and again, another great tax strategy is to know what buckets do I have. Can I possibly come up with a tax-free bucket? Can I possibly come up with a tax-deferred bucket? If I have both of those, which one do I use? Well, this one's talking about capital growth investments, go in the taxable one, or maybe in the tax-deferred one. But definitely would want to use the ordinary income cash flow investments to go in your tax advantage account. Remember, tax drag is not just the taxes that you pay, it's the lost compounded amount of money that you don't get because you paid taxes this year. And you want to I want to emphasize that, because you really want to understand that it isn't the money that you lose now to taxes. It's the amount of compounded returns you could have gotten had you put that in a more tax efficient vehicle. I hope that makes sense. I know some of this is way beyond some of you guys, and some of you guys, this is real basic. There's a wide range of sophistication on this call, but this is really important stuff, okay? And then leverage unrealized gains to compound tax-free, right? So that's going to be by 1031ing properties. I'm leveraging unrealized gains. I'm going to be, in JR's case, I'll use him as an example. I'm building auto repair shops. I'm buying them for $200K. I'm increasing their revenue so they're worth $2 million. I'm putting them together with other revenue, my other auto repair shops. If I sell those as a package, I'm compounding those unrealized gains, which is tax-free.